Are you frustrated with the stock market? Not sure when and where to invest your hard-earned money? This video is perfect for you. In this video we will go over some tips on knowing when to enter and exit the market. We will also touch on sector indices and how they can be used to make buy and sell decisions. If you like the video, please like and subscribe. Your support is greatly appreciated. Well, let's get started. I'll hand things over to my co-presenter.
Thank you. Okay. Well, when it comes to investing, there are a number of factors to consider. You need to have a clear understanding of your goals and objectives, as well as your risk tolerance. You also need to have a good understanding of the current market conditions. The global stock markets are constantly fluctuating, making it difficult to know when it's the best time to invest. However, there are certain things that you can look out for that will give you a better idea of when the market conditions are favorable for investing. Start with the Volatility Index and the S&P 500 Index. They are two indices that will help you to get an idea of current market conditions. You can also monitor the yield curve for signals of a start or end of a recession. The Volatility Index or VIX. The VIX measures how much volatility professional investors think the stock market will experience over the next 30 days. It is used to make predictions on the future performance of the stock market. A VIX of 0 to 12 means low volatility. A VIX of 13 to 19 is a normal range. A VIX of 20 or higher means higher volatility than normal. A VIX of 50 or higher is seen when there is an extreme market event, for example, a financial crisis or the onset of a global pandemic. An increase in the index means an increase in fear. The S&P 500 Index. The S&P 500 is a stock market index that comprises 500 of the largest publicly traded companies in the United States. It is used to represent the stock market as a whole and as an indicator of the strength of the U.S. equity market. It is one of the most commonly followed equity indices. Note that the VIX and the S&P 500 have an inverse relationship. The yield curve. The yield curve of the U.S. Treasury debt is a useful tool for monitoring investor sentiment, interest rate expectations, and overall economic stability. In a normal yield curve, long-term interest rates are higher than short-term interest rates. However, a yield curve can become inverted, showing long-term interest rates lower than short-term interest rates. Historically, an inverted yield curve found in the U.S. Treasury debt has preceded a recession in the U.S. Such an inversion reflects investor expectations that a severe economic downturn is imminent. Let's go into a little on FAANG and the tech industry. FAANG. You've probably heard the term before. What is it? FAANG is an acronym for Meta, formerly Facebook, Apple, Amazon, Netflix, and Alphabet, formerly Google. These tech giants dominate in various areas of technology, including artificial intelligence, e-commerce, online advertising, consumer electronics, cloud computing, computer software, media streaming, smart home, self-driving cars, and social networking. They are among the most valuable public companies globally. The Standard & Poor's classification of tech and FAANG. Technically, there is a difference between the companies included in the tech sector and FAANG. According to the Standard & Poor's newest system of classifying stocks, the technology sector includes companies that make and sell hardware, software, semiconductors, electronic equipment, and commercial data processing. FAANG has been moved from the technology sector to the new communication services sector. Keep in mind that most tech index funds that you can invest into today do include FAANG companies in their portfolios. The NDXT Index. The NDXT is an index used to measure the performance of tech stock. The NDXT does include FAANG companies in its assessment of the industry. Why this sudden mention of the tech sector and FAANG? In 2021, the tech sector and FAANG led in shareholders' return on investment. According to the BCG Annual Value Creators Report, the technology industry was the undisputed leader in 5-year total shareholder return of the 33 industries evaluated. The report indicated a median 5-year annual average total shareholder return of 30% year-end of 2021. The tech industry average was more than double the cross-industry average of 13%. It is important to note that for the purposes of the report, BCG has included FAANG companies in its tech report. In conclusion, for the average person, investing is a scary endeavor. It can be difficult to determine when it is a good time to be in the markets and when it is time to exit. Arming yourself with as much knowledge as possible is the key to investing with confidence. Thankfully, the bookshelves are stocked with quality books on personal investing. Moreover, the internet isn't a bad place to freely sift through information about current economic conditions. Due diligence is in order. Take your time. Learn about the market and how it behaves. Research sectors and individual stock. When you are confident about the buy and sell signals, move forward. There are no promises. There is just information gathering and decision making. Well, that's all for me. Hope that was helpful. Back to my co-presenter.
Thank you for watching this video. If you enjoyed it, please like and subscribe. Your support is greatly appreciated. For more wealth building content, please visit the website associated with the Wealth Legacy channel. The website's address is listed on your screen. There you will find articles, videos, helpful links, trading resources, and much more. Thank you again and see you next time.